I am joined from Dubai by Bhavik Mehta, Chief Market Analyst at Century Financial. Jimmy Damon says the impact of this crisis will last for years. We heard many analysts saying that it is not that huge or it's not a big problem. JP Morgan is saying, no, it is. What do you think?
Right. So when a guy like Jamie Dimon, who speaks, who's a big leader in the U.S. banking industry, when he makes such kind of a statement, it's definitely a point that the entire market, the entire U.S. regulators need to understand as to why this person is speaking such a big claim. Now, a bank like J.P. Morgan, led by Jamie Dimon, it's a bank that has, by the way, provided a $30 billion bailout along with other big banks to the small regional banks. That includes even the latest SVB collapse, with depositor funds being rescued by the Federal Depository Insurance Corporation. Now, what has happened is, if you look at the overall letter of which the Jamie Dimon has spoken about, he has highlighted one key component where the U.S. Federal Reserve stress test has never done a scenario testing when the interest rate starts rising. So before the start of this year, whatever stress test that the U.S. banks have been subject to by the U.S. Federal Reserve, they've never included a scenario where the U.S. interest rates rise sharply. So this is one big aspect which the annual letter has tried to address. And even before Jamie Dimon could in a way highlight this concern, the latest criteria rule that has been out by U.S. Federal Reserve in the February report, it has informed of keeping a scenario where it's going to keep a exogenous shock buffer, wherein a scenario what will happen to the banks if the inflation suddenly rises, if the economy goes into a deep recession. So that is something what the letter is trying to highlight.
So, you believe that the stress testing that the banks in the US have been subjected to were not appropriate in the current circumstances? How could they have been appropriate? What did they have need to do?
If you look at the various stress test results that have happened over the last 12 to 14 years, that is, ever since the 2008 grand financial crisis have happened, most of these stress tests have happened across 28 to 30 different variables. As an example, what happens if the GDP, US GDP decreases sharply? What happens if inflation rises by 2 or 3%? What happens if unemployment rate is rising? None of these scenarios had highlighted a scenario where, let's say, US short term yields, maybe 2 years, 3 years, or 5 years, suddenly spike by 200 to 400, about 200 to 400 basis points. So, till the December 2022 end, none of these scenarios included this, but the urgency has become such that even in the latest criteria report that the Fed is coming out, it has tried to soothe the market nerves, the banking sector nerves, by addressing this particular concern. So this is one aspect, like a sharp increase in the short-term yields and its repercussions across the different asset prices, whether it's equity sector, or whether it's housing sector, or what happens to the actual core economic mortgage prices and all. That is something that needs to be looked at.
In the piece of news we read about Diamond's letter, in his letter, he said that US regulators should not exaggerate in terms of introducing new legislations. What are the additional measures that could be enacted in the US, and what is Damon really warning against in this?
To answer the later part of your question, what exactly is Jamie Dimon trying to achieve? Well, I guess someone who's responsible for the US banking sector maybe is trying to highlight that the mistakes that happened in 2008, specifically with the $1 trillion collapse of the mortgage based securities that happened due to the Lehman crisis. So his letter should be seen as a warning by all the stakeholders, whether it's Federal Reserve, whether it's the US Congress, or even the banking participants, that the time is right for the regulatory authorities to go in with proper regulations. Now, some of the concerns that have been highlighted. So, to answer the first part of your question as to what exactly could have or should be going right, Most of the capital buffers and all are in place, and majority of the US banks are following it. But there is not a stringent guidelines as to what happens with the asset liability duration mismatch. So as happened with the Silicon Valley Bank collapse, uh, when interest rates were low, Silicon Valley Bank bought most of the treasuries that were at a very low yield. They had to apparently sell the same treasuries at a very high yield, incurring big losses. Now, coincidentally, this had to happen because there was a lot of depositor outflow money from the Silicon Valley Bank, and Silicon Valley Bank was just one of the regional banks who was specifically catering to the regional tech sector. So we're talking about the small as well as big tech firms in San Francisco, California, and other such established tech hubs. So what he basically wants to say to authorities is the right kind of balance as to how much the banks can invest in such kind of securities, and also to address the deposit diversification risk as to how much of the money should be concentrated in one sector. So it shouldn't be a scenario that one sector is dominating the entire deposit base.
Bhavik, Mehta, thank you so much for having us
Thank
on
you.
Century Financial. Thank you. Have a nice day. Hope to see you again on the show.
Thank you.